March data this morning signaling a still strong labor market, but Wall Street's attention remaining fairly fixed on President Trump's latest round of tariffs. Stock futures this morning extending Thursday's $3 trillion sell-off here. Economists can't seem to agree on what these tariffs mean for the Federal Reserve. Morgan Stanley seeing 0 cuts in 2025. Meantime, UBS predicting as many as 4. Joining us to discuss, Gus Faucher, PNC Financial Services Group's Chief Economist, also Brian Jacobsen, Annex Wealth Management's Chief Economist and Strategist as well. Thank you both so much for being here. Brian, I want to start with you. I get the sense that you think that the market is overreacting to these tariffs. Why is that? What makes you confident that we're going to see compromise that leads to a bit of a rebound?
Yeah, thank you for having me. Yeah, when we were looking at the announcement from President Trump and even how he campaigned, we weren't really that surprised that he did launch these reciprocal tariffs. Obviously, the scope of them, that it was based upon a formula, and as far as the countries that were targeted, that was a little surprising. But we think that really this is a starting point for the negotiations. And we do need to wait to see, do these actually go into effect on April 9th? Right now, it's a rather intense period. We do have the certainty of the announcement, but now there's the uncertainty about how is this possibly resolved and at what level do the tariffs eventually settle at. So we think that it's actually understandable why the market would react in a negative way for it to the announcement, but we don't think it necessarily needs to, with the uncertainty, to resolve all that unfavorably as what the market is pricing in.
Gus, so not only are we seeing sort of some contradictions amongst White House staff as to whether these tariffs are open to negotiation, there's sort of contradiction from the president himself. He said last night, yes, these are up for negotiation. We're ready to start the negotiation now. Then he came out in a post this morning and said, my policies will never change. So if you're another country and you're trying to negotiate with him, how do you even do that? And how does the market interpret whether that's going to happen?
Well, I'm an economist and not a political scientist, so I can't tell you how other countries are going to respond. But what I can tell you is that this means that U.S. consumers and businesses are likely to remain on hold. We have these very large tariffs that are in place or are supposed to be put in place over the next week or two. But the president is talking about potentially rescinding at least part of them. How do you make a decision under those circumstances? You simply can't. And we need more clarity one way or the other so businesses feel comfortable making investment decisions. Consumers feel comfortable making decisions about a big purchase such as a car. And until we get some clarity, I think things are going to remain very complicated. I think we're going to see that uncertainty in and of itself as a drag on the economy until there's at least a clear picture of what these tariffs are going to look like over the longer run.
Well, Brian, going back to you, if you are potentially wrong and these tariffs are going to stick around for the longer run, where do investors need to potentially be hiding out while these tariffs take their effect?
Yeah, that's a great question. That's one of the things that we really focused on when coming into this year is about what if we are wrong? Where do we want to be? And it's trying to really assess what's the distribution of possible outcomes. And so one of the things that we have been really focused on is focusing on profitable companies, those that are profitable even in the face of perhaps heightened tariffs on intermediate goods, final goods, and the such, that they have that margin of safety, not just from a valuation perspective, but even from the fundamentals perspective. And so I think that's what's really a little bit unique about the approach that we took coming into this year, which is why we've a lot of our portfolios have held up fairly well. I mean, it hasn't been completely unscathed, is that almost double focus on not just the valuation, but also on the fundamental side of things. And really right now, we're positioning more for, let's say, healthcare, financials, even some of the industrials that we think are going to be able to be relative beneficiaries. Maybe everybody loses in this game, but it's more a question of just kind of that story about if you're out hiking and you encounter a bear, you don't have to outrun the bear, you just have to outrun the person that you're with.
Speaking of fundamentals, Gus, let's linger for a moment on the thing that we would have been talking about today more were it not for the tariffs. That's the jobs report, which did come in a little bit better than estimated. But do you just sort of discount this one or give it a lot less weight because we're waiting for the effects of both some of the government layoffs and the tariffs?
Yeah, I mean, certainly we do expect to see the government layoffs show up later in the data later this year. If you took a buyout from the federal government, you're still counted as employed. So many of those workers are not showing up in the job loss data yet. I expect that we'll see those hit in the second half of 2025. But that being said, the economic fundamentals are still good. We have a solid labor market. We have a low unemployment rate. Initial claims for unemployment insurance remain low. And I think that if this uncertainty is resolved, then we can return to solid economic growth that we've seen over the past few years with a solid labor market and slowing inflation. But I think the tariffs, the uncertainty surrounding the tariffs will be drags on the economy that are more likely to show up in the data later this year.
And Brian, going back to you on this, I wonder what you're telling clients right now amid this uncertainty, and more broadly, how they're thinking about whether or not a wrap up to that certain uncertainty could potentially lead to a lift in markets.
Yeah, so a lot of the clients, they're long-standing clients, so they have been with us for many years, and so it's a little bit easier in that situation because you can say, hey, let's take a step back, look at what's happened over the last 2 to 3 years. We do expect that in any given year, you could have a 10 to 15% decline, right? The last 75 years of market data suggests that the average drawdown in a given year is around 14%. So it's something that you expect. It's never pleasant when it happens, but if you take that step back and focus on where have I come and now where are we headed towards, viewing sometimes this volatility as an opportunity to upgrade the quality of the portfolio, to realign with that longer term financial plan. So really trying to just take that step back and take a breath to provide that perspective. But then also it's in terms of where's the opportunity in the moment to not panic, but to view it more as an opportunity.
Brian, what would make you panic? Or what would make you, you seem very even-keeled in the face of all of this. What would make you more concerned here?
Well, maybe that's just because, season of Lent, I gave up panicking for Lent, right? So we'll have to see what happens after Easter, after I can kind of go back to my normal skittish self. But in terms of what would make me panic would be if the Federal Reserve's messaging was a little bit more hawkish. What I heard from a number of officials yesterday, and we'll hear from Chair Powell, I'll be tuning in on Yahoo Finance later to listen to that, is if he's talking about, the inflation does have us more worried. But what I've heard so far is that they are tilting more towards what's the growth slowdown effects. And so if the Fed was going to be more restrictive now that we have restrictive trade policy and arguably restrictive fiscal policy, I think that would really begin to make me think that we are going into a recession and that this correction becomes more of a bear market instead.